A customer's car rolls into a repair bay, making a strange rattling noise. The technician listens for a few seconds and nods with quiet confidence. 40 minutes later, the final bill lands $300 higher than expected. Most customers just sigh, pay the total, and drive away. Almost nobody asks where that extra money actually goes. They assume the mechanic keeps most of it as pure profit. The real financial story inside a repair shop is far more complicated. Behind every oil change and brake job sits a hidden money machine. Some shops quietly generate 6 figures in profit every single year. Others open with excitement and close within their first 3 years. 2 shops can have identical tools and identical busy parking lots. Yet their financial outcomes can be worlds apart. So what really separates a thriving repair shop from a failing one? It is not simply how many cars pull into the lot. It is something most new owners never fully understand, not until the losses have already piled up. This is the hidden economics behind the auto repair business. And once you see it, a repair shop never looks the same again. On the surface, auto repair looks like one of the safest businesses around. Cars break down every single day, in every city, in every economy. People need working vehicles, whether times are good or times are hard. That feels like guaranteed recession-resistant demand. New owners see a packed shop and imagine effortless cash flow. They watch a mechanic bill out at $140 an hour. They assume most of that hourly rate lands straight in the owner's pocket. They picture a stable trade business built on loyal, repeat customers. In this industry, trust can feel stronger than almost anywhere else. A good mechanic often becomes a family's mechanic for life. That loyalty looks like a built-in, self-sustaining revenue engine. Many buyers also assume repeat customers eliminate the need for constant marketing. That assumption alone convinces many first-time buyers to move forward quickly. Every visit also comes with parts sales stacked on top of labor. It starts to look like a business that practically sells itself. No flashy marketing required, just steady hands and a solid reputation. That perception pulls thousands of new owners into the industry every year. Former technicians dream of finally working for themselves instead of someone else. Investors see stable local demand and dependable long-term real estate value. On paper, this looks like a business almost impossible to lose money in. In reality, the margins are far thinner than most people assume. The real economics only reveal themselves after the doors actually open. And by then, many owners have already committed their entire savings. Understanding the real numbers early can be the difference between survival and collapse. So let's break down what it truly costs to open the doors, and what it really takes to keep them open profitably. Opening a real repair shop is nowhere near cheap. A small independent shop can realistically start around $150,000. A larger, fully equipped shop can easily cross $500,000. The first major expense is almost always the building itself. Repair shops need real square footage, not just a small storefront space. Zoning laws must specifically allow a service garage at that location. That single requirement eliminates a huge number of possible sites. Then come vehicle lifts, and lifts are genuinely expensive. A single quality lift can cost $5,000 to $15,000. Most functional shops need at least 3 or 4 lifts running. Diagnostic scan tools add another $10,000 to $30,000 on top. Modern vehicles are essentially rolling computers now. Old generation tools simply cannot read their onboard systems anymore. Air compressors, alignment machines, and specialty tools stack the bill even higher. Then there is the starting parts inventory to consider. Shelves need brake pads, filters, fluids, and common replacement parts stocked. That opening inventory alone can run $20,000 to $50,000. Licensing and insurance requirements come next, and neither one is optional. Liability insurance is critical since mistakes on a vehicle can be dangerous. Environmental permits are required for handling oil, coolant, and hazardous waste. Technicians often need ASE certifications to be trusted and properly insurable. Skilled labor becomes expensive before a single customer even walks in. Experienced technicians typically expect $25 to $40 an hour in wages. Some elite specialists command even higher pay than that. Payroll starts draining cash the very moment the doors open. Software for scheduling, invoicing, and digital inspections adds another monthly cost. Signage, office furniture, computers, and basic renovations all add up quickly. Working capital becomes critical to survive the first few slow months. Most new shops need 3 to 6 months of cash reserves ready. That reserve is needed before a single dollar of real profit appears. This is exactly why so many shops open underfunded from day one. Franchise routes exist too, with fees ranging from $30,000 to $50,000. But franchise fees come on top of the same core startup costs. Buying an existing shop instead of building new can lower some of these costs. But existing shops come with their own hidden liabilities and worn equipment. Entry into this industry is far heavier than most people expect. Once the shop actually opens, the real business model becomes clear. A repair shop technically sells two very different products. It sells labor, and it separately sells parts. Customers usually focus only on the total number at the bottom. They rarely separate what they're paying for labor versus parts. That blurred line is exactly where the hidden profit lives. Labor is billed using something called a flat rate book. A brake job might be officially billed at 2 full hours of labor. A skilled technician might actually finish that same job in 1 hour. The shop still bills the customer for the full 2 hours listed. That gap between build time and real time is called shop efficiency. High efficiency is where the true profit engine actually lives. A technician paid $25 an hour can generate far more value. Billed out at $140 an hour, the math shifts fast. That spread between labor cost and labor price is pure gross margin. Now layer parts pricing on top of that labor margin. Shops rarely sell parts at the exact price they originally paid. A part bought wholesale for $40 might resell for $80. Markups of 40 to 100% are extremely common in this industry. Customers question labor rates far more than they question parts pricing. That quiet parts markup often outperforms labor profit entirely. Combine labor margin and parts margin, and the real math finally emerges. Gross margins across labor and parts can reach 50 to 60%. That number sounds impressive sitting on a spreadsheet. But gross margin is never the same thing as final take-home profit. There's also the digital inspection strategy running quietly in the background. Technicians are trained to check for extra issues during every single visit. A simple oil change often turns into a longer recommended repair list. Worn belts, low fluids, and aging brake pads get flagged immediately. Each flagged item becomes another small revenue opportunity for the shop. Multi-point inspections turn a 5-minute visit into a larger recommended service list. Shops also profit heavily from recurring maintenance cycles. Oil changes, tire rotations, and inspections bring the same customers back repeatedly. Loyalty reminders and service alerts quietly pull customers back before problems start. Fleet contracts with local businesses add steady, predictable repeat revenue. Some shops partner directly with financing companies for larger repairs. That financing option increases how much customers are willing to approve. Seasonal services boost revenue in very predictable, repeatable waves. Air conditioning repairs spike heavily during the hottest summer months. Battery replacements and heating repairs spike during the coldest winter months. Every season quietly creates its own built-in revenue cycle. Cabin filters, wiper blades, and small accessories add steady little margin boosts. Extended service contracts and warranty upsells add another thin profit layer. On the surface, all of this looks like a strong, stable cash machine. And for a well-run shop, it genuinely can be exactly that. But underneath that surface, money leaks out constantly. The single biggest hidden cost is technician turnover. Skilled mechanics are in short supply almost everywhere right now. Losing one experienced technician can quietly cripple a shop's daily output. Training a suitable replacement can take months, sometimes even longer. During that gap, revenue drops sharply while rent keeps arriving anyway. Comebacks are another silent, recurring profit killer. A comeback happens when a repair fails and must be redone. That redo work is almost always completed for free. Free labor means paid wages with zero matching revenue coming back in. Too many comebacks in 1 month can wipe out that month's profit entirely. Diagnostic time is another quiet, constant drain on the schedule. Technicians spend real-time diagnosing a problem before any fix even begins. Some of that diagnostic time is never fully billed to the customer. Estimates written for repairs customers later decline also cost unpaid labor hours. No-show appointments waste blocked bay time that could have been billed elsewhere. Equipment breaks down too, and equipment repairs are never cheap. A broken lift or a dead scan tool can pause an entire bay. Every idle bay represents pure lost revenue for that entire day. Hazardous waste disposal fees add up quietly, month after month. Used oil, old coolant, and worn tires all require paid disposal. Credit card processing fees quietly shave a slice off every single ticket. Marketing costs keep rising as more shops compete for local attention online. Online reviews and search visibility now demand constant, ongoing investment. Insurance premiums climb steadily as claims and industry risk increase. Rent increases can silently erode margins year after year after year. Many shops sit in high-visibility, high-traffic locations for good reason. Those prime locations come attached to premium lease pricing. Some technicians even finance their own tools through tool trucks. That personal financial pressure can quietly increase turnover and burnout. Slow-moving inventory also ties up cash sitting uselessly on the shelf. A specialty part ordered for one unusual car may never be needed again. Every dollar sitting in unused parts is a dollar not actively working. Some manufacturers restrict repair data access, forcing shops to pay extra fees. New vehicle software updates can require costly new diagnostic tool subscriptions. Liability risk hovers silently over every single job completed. A misdiagnosed repair can lead to expensive, drawn-out legal exposure. One serious mistake can threaten years of carefully built reputation. Workers' compensation costs also climb in a physically demanding trade like this. All of these smaller leaks quietly add up faster than owners expect. A shop can look fully booked from open to close and still struggle. Being busy on paper is simply not the same as being profitable. This is exactly why so many repair shops quietly struggle behind closed doors. A packed parking lot can still be sitting on razor-thin margins. Owners often underprice labor just to stay competitive with local rivals. That pricing pressure quietly erodes profit on nearly every single job. Competition from national chains adds even heavier pressure to the market. Big chains use bulk parts pricing that small independents simply cannot match. Dealerships compete directly for newer, warranty-covered vehicles in the area. That competition pulls higher-margin newer cars away from independent shops. The ongoing technician shortage makes staffing a constant, expensive battle. Good mechanics can demand higher pay or simply walk away entirely. Owners often end up working the bay themselves just to cover gaps. That leaves far less time to actually manage the business side. Cash flow gets tight whenever large parts orders are needed up front. Suppliers expect fast payment, while customers rarely pay quite as fast. Seasonal slow periods can quietly drain hard-earned cash reserves. Certain regions see noticeably fewer walk-in repairs during colder months. A single slow month can erase weeks of prior hard-earned profit. Electric vehicles are starting to reshape the entire industry's future. EVs need far less traditional maintenance compared to gas-powered vehicles. Oil changes disappear entirely, forcing future revenue models to shift. Shops that fail to adapt now risk losing long-term relevance later. Many owners also underestimate real marketing and customer acquisition costs. Trust builds slowly over years, but competitors can undercut pricing instantly. Family-run shops sometimes struggle to modernize pricing and scheduling systems. Owners who never update their labor rates slowly fall behind rising costs. Owners without strong internal systems often bleed money without realizing it. Without tracking efficiency, comebacks, and true margins, real profit stays invisible. A shrinking pipeline of new technicians makes long-term staffing even harder. Fewer young workers are entering the trade compared to decades past. That labor gap quietly threatens the entire industry's future growth. This is the real reason so many shops fail so quietly, not because cars suddenly stopped breaking down, but because the hidden math was never fully understood or tracked. So is owning an auto repair shop actually a good business to run? The honest answer is, it depends almost entirely on execution. This is not a passive investment by any reasonable measure. It rewards operators who master labor efficiency above absolutely everything else. It rewards shops that tightly control comebacks and protect their reputation. It rewards owners who track true margins, not just total revenue numbers. Done well, net profit margins can land around 10 to 20%. Done poorly, many shops barely break even year after year. The best-run shops treat labor almost like a precision manufacturing line. Every hour of a technician's time becomes a carefully measured asset. The worst-run shops simply react to whatever walks through the door. Location still matters, but operational skill matters even more than location. A high-traffic street can never fix a poorly managed shop underneath it. A modest location can genuinely thrive under sharp, disciplined management. For hands-on owners willing to manage every detail, the reward can be substantial. For passive owners hoping to hire away every decision, the risk multiplies fast. This is a business built on trust, precision, and hidden efficiency. The mechanics turning wrenches are only ever half of the real story. The other half is happening quietly in the numbers behind the counter. Every flat rate hour, every parts markup, every comeback truly matters. That is exactly where real profit quietly lives or quietly disappears. Auto repair will always remain a needed, remarkably resilient service. But being needed does not automatically mean being profitable. The shops that last are the ones that master their own internal math. Next time you walk past a busy repair shop parking lot, remember that busy is never actual proof of real profit. True profit hides inside efficiency, not simply inside activity. And that hidden math is the real business behind auto repair.